In the previous segment, we introduced you to term life insurance. And now I want to cover a couple of features about term life insurance, specifically the renewability and convertibility options available under term insurance. You may recall that we discussed term insurance as for a specific term, and at the end of that term, your insurance is actually terminated. However, if your plan has a renewable feature, that means at the end of your term, you can in fact renew it for another term. And so term plans can be renewable or non-renewable. Most of the ones sold today are renewable plans. And so with a renewable plan, at the end of the term, your policy will be renewed for another term. And in fact, as the insured, when it renews, they do not need to provide any additional evidence of insurability. Now, at the time of renewal, obviously they're going to be older. Let's say, for example, we had a 10-year term policy that someone purchased at the age 30. At age 40, the term is over, but the person would like to renew it for another 10 years. And if they renew it for another 10 years, simply because they are now 10 years older, the mortality cost is going to be higher because their risk of dying is higher. And so when you renew the policy for another 10 years, in my example, you're going to have to pay a higher premium. Now, the insurance companies in a renewable term plan will already let you know up front from day one what the cost is going to be to renew this policy at the end of the term. So your renewal premiums will increase as you get older, but they are guaranteed and they are printed in the contract, so you know exactly how much it's going to cost you. Now, you do not have to renew the policy, but if you do, you get your insurance coverage for another term. And as I said earlier, you do not have to provide any medical evidence of insurability at that point in time. So that's a pretty good feature. Now, some companies will allow you at the end of the term to in fact provide them with medical evidence of insurability. And if you're still healthy, in fact, they will quote you a new premium, which in fact will be lower than the guaranteed premium that they offered you in the original policy. And the reason for that is obviously they're now seeing your medical information at the point of renewal. If they don't see that medical information at the point of renewal, they don't know whether you're healthy or not any longer, and that's why the guaranteed renewal premium that you have will likely be higher than if you provided them with medical evidence of insurability at the time of renewal. And so that type of capability or policy is called a re-entry term. They allow you to re-enter by providing medical evidence, and if you're healthy, they'll quote you a new premium, which is usually lower than the guaranteed renewal premium. So let's talk now about the convertibility option. As I said earlier, term insurance is for a specific term, and we also learned that in fact most term insurance plans will expire usually between age 75 and 80. So if you need coverage beyond that, you're not going to have it. Convertibility, the convertibility option, is a feature that term insurance plans have that allow you at any time to convert your term plan to a permanent insurance plan with the same insurer. And at the time you convert, again, you can do that without providing any additional medical proof of insurability. And so when we convert our plan, we in fact now have a permanent plan. Our premium at that point in time, because now we have a permanent plan, our premium is going to likely go up because A, we're older, but also we're now buying an insurance policy that we are going to keep for the rest of our life. It's likely that people that convert their term insurance plan to a permanent plan, because they don't have to provide medical evidence, they tend to be in more of a deteriorated health situation, because if they were healthy, they would in fact provide medical evidence and get a new policy at that point in time. But it's likely that when they convert, many people may not be able to get insurance because maybe they're older, not as healthy, they may be uninsurable, or they may have some sort of medical issue that maybe the insurance is going to cost them a bit more. So the convertibility feature on term insurance plans is quite a valuable feature if you decide you need coverage beyond age 70 or 75. Now, one of the things you have to think about is how much am I going to pay when I obviously convert my plan to a permanent plan. And as I said earlier, insurance companies will charge you the premium at your then attained age. So if I bought a term insurance plan at age 30 and at age 45 I decide, oh, I want to convert it to a permanent insurance plan, I will be paying the premium at my age 45, which is the age I am at the time I decided to convert that policy. Now, insurance companies have different approaches as to actually how old I am when I convert a policy. There are 3 different approaches they use to determine your attained age at the time of conversion. First of all, they can use something called age last birthday. And so when you convert, they will look at what was your birthday, your last birthday, how old were you, and they'll use that age to determine your premium. A second option is something called age nearest birthday. Age nearest birthday basically says which birthday is closest. Are you closest to your next birthday, or are you in fact closest to your previous birthday? So usually on age nearest, we're usually looking at the 6-month point. Are you over that 6-month point? If you are, it's going to be your next age. Or are you before the 6-month point? And that will determine that you are still at your nearest birthday is still going to be your previous birthday. So we have age last birthday, pretty simple to figure that out. We have age nearest, where we have to say, am I over the 6-month point or not? Some companies will use age next birthday. And so you can see on the slide, here's an individual, a date of birth November 20th, 1990. Today, let's say it's June 7th, 2018. And if the company is using a last birth date approach, the individual today is going to be, for insurance purposes, age 27. If in fact they're using age nearest or age next, they're going to be 28 years old. Now, there are some companies today that in fact when you convert, they will still use the premium at your original age. So in my example, if I bought the insurance at age 30 and I'm going to convert at age 45, they will use my age 30 to determine my premium for the permanent insurance plan. Not a lot of these companies or these plans left today, but that's an option that is available. So when we're converting a policy, we need to know what is our attained age at the date of conversion so that we can determine how much our premium is. So let's review term insurance. Again, advantages. Very simply, low initial cost. You're paying for pure risk protection. Your premiums are guaranteed. We have the renewable and convertibility feature that I talked about. And in fact, you can customize the plan. We talked about multiple lives, single lives. And so you're able to customize the plan specifically to what your requirement is. If you have a mortgage of $325,000, you can buy a plan for $325,000 of coverage. Some of the disadvantages of term insurance are, as we get older and as our policy renews, our premiums are going to increase because our mortality is increased. And past a certain age, we cannot get term insurance any longer. The other disadvantage of term insurance is that if we cancel our plan, we actually get nothing back. We have simply been paying a premium for pure risk coverage. And so on termination of the plan, you've had risk coverage while you had it. When you terminate the plan, it really is, you get nothing back. When we talk about permanent insurance, we're going to see that that's different than term insurance, in that permanent insurance provides you some additional refund or additional cash value or account value that you can get back if in fact you decide to terminate the plan. So, common uses of term life insurance. We want to cover risks that will end before age 60 or 70. It's short-term risk for a known duration that we want to cover. We can cover decreasing risks. I talked about bank loans, mortgages. In some situations, you may have an obligation under a divorce agreement where one person may have to pay alimony for 5 years to an ex-spouse. And in fact, if that person passes away, the obligation to continue making those alimony payments is still there. And so in certain divorce obligations, decreasing term insurance is used to make sure that the money is still there to meet those alimony payments for the remainder of the term. Again, term insurance, if you've got limited cash flow, you need coverage but you don't have as much money, or you decide, no, I simply want to have pure risk, then term insurance is in fact inexpensive. And some people decide that they're going to invest outside of their insurance plans. In fact, they think they can do better, and they rather just simply have pure term coverage, and then the investments or savings they're going to do outside with other alternative vehicles. And so that wraps up our segment on term life insurance.